and begin. Thank you all for joining us today. We have a great panel lined up for you to discuss business planning strategies in uncertain times. Before we get to that, a few housekeeping things. My name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. We are membership based. We have members in private equity, investment banking, lending, independent sponsors. We have chapters in Los Angeles, Chicago, and New York, where we typically do monthly seminars, currently doing them virtually. And in addition to those monthly seminars, we do deal sourcing events, typically around the nation, 15, 16 different markets. So if you want to learn a little bit more about Opus Connect, feel free to reach out to my colleague, Jacob Zeffrin. His contact information is at the bottom of the screen there, and he'll be more than happy to answer any questions you might have. Quick logistical point, our panel will be taking live Q&A today. So as they move through the discussion and questions pop in your minds, you'll see a Q&A box at the bottom of your screen. Feel free to submit your written questions there, and our moderator will field those. We'll try to get to as many as we can. If you are a sponsor of today's event, please raise your hand. But before we begin, I definitely want to give each of them an opportunity to introduce themselves. And we're going to start with Ice Miller. I'm not sure if anyone is on the call today, and I don't believe so. If you are, raise your hand. But Ice Miller has been a longtime friend and supporter of Opus Connect. If we weren't doing this virtually, we'd be in their offices in New York, so we definitely want to thank them for their ongoing support. Next, we have Nfp Insurance. Is Duncan on the phone? I don't believe he is. Raise your hand if you're in here, Duncan. They also have been a longtime supporter. They do insurance based in New York. If you have any questions, feel free to reach out to Duncan Cummings. His contact information is down below. 4 Degrees. Ablorde, are you on? Everybody has a busy afternoon. That's good. Ablorde is not on the phone. 4 Degrees. They're a newer sponsor, but have been sponsoring a few of our different events. So if you have any questions, his contact information is there as well. We're going to move on to Focus Search Partners. Steve Finder, I see you here. Steve, go ahead and introduce yourself and your firm, please.
Hi, thanks, Lena. Appreciate everybody being here. I'm a managing partner with Focus Search Partners, about 30 plus of us around the US, focusing on 2 areas. One, we have a strategy arm that focuses on operations and efficiency and everything around the CFO's office, among others. And then a retained executive search business focusing on technology, private equity-backed technology companies, healthcare, industrial, and consumer. So excited to be here, and thanks for letting me have a minute there, Lena.
Absolutely. Thank you, Steve. Moving on, last but not least, Resourcive. Nick, I see you in here. Please introduce yourself and your firm.
Thanks, Lena. Yeah, Nick Cressy, Managing Director here at Resourcive. We're a firm of subject matter experts specializing in IT spend reduction in portfolio companies around the globe. Happy to be here today. Really what we're doing right now is focused on reducing CapEx, creating some flexibility in the OpEx side of the business, leveraging innovative technology. And I think it fits right into the business planning in uncertain times, right? With the work from home environment and having to stay efficient, and while also having a focus on that security awareness is really where we're being leveraged right now by firms. So happy to be here and interested to hear what the panelists say today.
Thank you, Nick. Before we get to the discussion, we have one poll question that we want to ask everybody. This is an opportunity to have your voice heard, so we're going to pop that question up on the screen here. We want to get a poll on the audience. How long do you think this recession is going to last? 3 to 6 months, 6 to 12 months, 12 to 24 months, or over 2 years? Go ahead and submit your answers there. We'll give it about 15 seconds, and it'll be helpful for the panel to understand where you all see it, and then we'll get to the discussion. Great. It looks like we can end that poll. Majority 12 to 24 months, 38%, 36% thinking 6 to 12 months, 17% thinking over 2 years, over 24 months, and 10% 3 to 6. Optimistic. So without further ado, I'd like to introduce today's moderator, Martin Wentzel of American Industrial Acquisition Corp. Martin, I'm going to bow out now and let you take it away.
Yeah, thank you, Lena, and also thank you to everybody at Opus Connect for making this possible, and thanks to everybody on the panel. I know you're taking time out of your busy schedule, and obviously also thanks to everybody in the audience. Just a quick word about American Industrial Acquisition Corporation. I'm an operating partner and managing director here, and we invest in special situations in the middle market in the manufacturing sector. We have about 70 manufacturing locations across the US, Europe, and Asia, and invest our own capital. And as a result, we are able to look at all types of special situations. And we have a focus on operations, which means that most of our senior operators or senior members of the firm have an operating or managing or C-level corporate experience. So we can go quite operational on our acquisitions. Professional background of mine, I worked at Siemens for a long time in M&A, turnkey project management and design implementation for baggage handling systems, and also in line management for engineering, manufacturing management for mechanical systems. That's, I think, enough about me. I would also like to introduce my panel as a next step. So we'll start with Cynthia from Cohn-Resnick. She's a global director of the restructuring practice. And maybe, Cynthia, you can say a few words about you and your background.
Sure. Thank you so much to Opus Connect for having me today, and to Martin for moderating this great panel, and to all the panelists here today. My name is Cynthia Romano. I co-head the restructuring and dispute resolution practice at Cohn-Resnick, which is the 11th largest accounting firm in the country, but most recently has become known for its advisory practices, where they pivoted a few years ago and made large investments in both advisory and innovation, and now have over 500 people in the advisory practices, from healthy companies to restructuring to technology to risk management. We are middle market. We service clients from 50 million up to about $1 billion. We can do lower or higher depending on the need, but that's where the sweet spot's probably 100 to 500 million. We are industry agnostic and ride whatever wave is happening right now. That is most industries. We do both debtor and creditor work, although my personal practice is debtor side, and we work both in and out of court, and my personal practice tends to be more out of court. We do workouts for lenders, sponsors, and landlords, fixing for interim management, turnarounds, fiduciary roles, restructuring, exits, including transactions, as well as wind downs and liquidations, and capital sourcing. Very happy to be here, and thanks again for having me.
Thank you. So let's switch over to Rick Braun, operating partner at Genex 360.
Hi, thank you all. Thank you, Opus Connect, as well as Martin, for the introduction there. I'm an operating partner with Genex 360 Capital Partners based in New York. We're a middle market firm that specializes in manufacturing and industrial business-to-business service kind of companies, mainly across North America, although we have a few that are outside. We're in our third fund now with about $1.5 billion of assets under management. And we look for business models that are really going to require some sort of operational change, whether that's expanding margins or accelerating revenue growth, anything that's going to be focused around delivering and generating stronger financial returns. So typically, we're looking at transactions that are in the size of 50 million to 200 million. And we like businesses in aerospace, packaging, transportation, food processing, to name a few types of markets or industries that we specialize in. Before private equity, I'm formerly an executive in some of the larger aerospace companies, where I spent 25 years working for companies like Pratt & Whitney or Rolls-Royce aero engine companies. And I ran several large service centers for those companies around the globe. So after spending about 15 years abroad, it's been nice returning back to the United States, based down here in South Florida with my wife and 4 kids, and really enjoying the work I'm doing with Genex 360. Thank you again.
Thank you. And last but not least, Sean Oswald, managing partner at the Riverside company.
Great, thanks, Martin, and thanks to Opus Connect and everyone for joining today. As Martin said, I'm the managing partner and fund manager within Riverside of a new initiative that we're calling the Riverside Value Fund. The Value Fund is something that we just started with Riverside last summer, and it's a lower middle market fund that's targeting businesses that have operational improvement opportunities or businesses going through operational financial challenges. We typically focus on businesses with revenue in the $50 to $250 million range. And more broadly, Riverside is a $9 billion global asset management firm focused on lower middle market, private equity and credit investing in North America, Europe, and Australia. And the firm has about 300 people worldwide. Before joining Riverside, I was with Aurora Capital. I'm based in Los Angeles and was also with Aurora in Los Angeles for about 5 years, and then was with HIG Capital for about 9 years before that.
All right, good. So before we start the real discussion, I just wanted to give the audience a little bit of context as well, so that you know a little bit more why we chose this topic. AIC is, as I said before, is a distressed investor, which also means that the pandemic has not all been bad for us, at least in a business sense. And we do see, though, that we have to operate differently now. Situations that we come across are more complex. Due diligence activities are limited, mostly to virtual meetings. We see companies that are in a shutdown scenario. We see companies that are loss-making, probably breaking a very profitable track record from the past. We see one-time events that may be triggers in supply chain disruption or in the customer base. So overall, we see that the established tools that we get, let's say like a due diligence that circles around a 5-year business plan, is a lot less meaningful to us at this point. And so we thought, why don't we have a chat with, or why do I not have a chat with peers about this topic and see what other people experience, and at the same time we can invite an audience. So that's how we came to setting up this panel. And since we are a little bit focused also on the timeline, we'll just basically focus on the business plan of or the business plan topic as the main question that we want to discuss. So finally, and now without any further delay, let's get in. The first question that I want to bring to the panel is really just to set the frame a little bit, and that is basically what new challenges do you see in creating or in analyzing business plans today? And then maybe I want to start with Sean for the first question. What do you guys see there?
Yeah, sure. I think everyone would agree that whatever we used to do 3 or 4 months ago, it's definitely different today, and it's changing real time. And so it's really, I think we're all learning as we go. But for us, at least, it's definitely been sector specific and trying to understand the impact of COVID-19 globally on different sectors. In some businesses, the impact has actually been positive. Riverside owns a company over in Europe called Bike24, and we've just had our highest 2 months of sales ever. It's an online e-commerce business delivering bikes to people for cycling at home, and they're doing extremely well right now. And then we have other businesses that are obviously more challenged. And so I think really trying to understand the impact, both in terms of the severity of the decline in sales and orders, and as well as the length of time it may last, is really sector specific. And we're having to think about analyzing those sectors very differently than what we used to do in the past. I also just add that it's changing week to week too. So we have a portfolio company, for example, that sells ignition interlock devices for DUI offenders. And so people are drinking more, but driving less, and court systems are closed and DMV offices are closed, but states are behaving very differently. And so really having to dig in and understand that business on a state-by-state basis right now.
Yeah, I think that's very interesting that it really depends on the sector, even the subsector. Does that mirror what you see, Cynthia?
So I think all the things that Sean said, I certainly want to echo. The fact that there really are no perfect answers. We are all feeling our way through this, and anybody who tells you that they have an answer is either arrogant or naive. The fact that the impacts are very sector specific, and that then has very sector specific impacts on how you would do a business plan for a transaction. And then lastly, that it's evolving. Where we were 2 weeks ago is not where we are today. Some states have opened, some states have partially opened, some states like New York metro area are still mostly shut down. And so as we think about business planning in this environment, particularly if you think about a distressed transaction, you always have the problem of imperfect information, inadequate information, not enough time. But right now we've got a particular challenge that again is sector specific, which is where was the company pre-pandemic and where is it today? And then where do you make your jumping off point for where it's going to be tomorrow, next year, 3 years, as you do your projections to think about how this company evolves? And I think some of that goes to the industry or the subsector of the industry. So was the demand disruption temporary or permanent? And if it was temporary, when does it return? If it was permanent, was it a full disruption or will it partially return? And if so, when? And then thinking about things like triage and what do you do post triage and how do you get the business back to where it could be? Right? Historically, we've looked at history as the predictor of the future. I think everyone's not so sure that the future is going to look like exactly like the past. So the time frame for recovery becomes critically important to make some assumptions about. And then in addition, capital and what's happening with the flow of capital becomes critically important because businesses will need capital. And lenders have been highly cooperative thus far, but as we think forward and as business planning takes place, can you continue to count on that cooperation? Or my personal view is that we're going to hit a point where lenders take stock of their portfolios, as will equity investors, and say, is this a company that I want to continue to invest in or fund or not? And then at that point, I think all hell will break loose as the sorting out of those who make it and those who don't proceed.
You mentioned that the history is probably less relevant now that there are a lot of changes short term. Do you think that overall investors look more towards a business plan in the future rather than probably comparing it to historic financials then at this point?
So if it were me and I were doing a business plan, I think you start with where the company is right now, which for many, many companies is shut down and not doing any business. And then you begin to make some assumptions about when the restart happens for the markets that they're in, what happens to the supply chain for the markets that supply them. And then from there, some educated guesses and best guess really about where demand goes from there. Does it return in a stair-step function? Does it return in a hockey stick function? Does it blossom immediately because everyone's now let out of jail and looking to go back and eat out again and then drop off? So I think it's a best guess assumption, but I start with where are they today? And you look at the past as where perhaps they could get to. And if they weren't doing well in the past, then perhaps you even surpass that with could they do better than they had been doing?
Yeah, okay. I think that's a good point to convert or translate the discussion a little bit more to the blind spots maybe then of conventional business planning and what basically still works and what doesn't work anymore that well. Maybe Rick, what do you think about I would say like really the areas that are not covered by business planning in the traditional sense that would probably create blind spots today?
Sure, Martin, thanks. And just before I go on to that, adding on to what Cynthia mentioned, one of the newest challenges too is—
Sorry to interrupt. Do you mind speaking up just a little bit?
Sure, no problem.
That's much better.
Is this any better? All right. That certainly in terms of business planning, not just interfering with the management teams that are running these businesses. You can't do that when they're trying to manage these businesses going through these downturns. It certainly requires more impetus on our parts to really help them get through those things. But going into the blind spot, I certainly would say we've seen a few issues and pivoted in that situation to then capitalize on something we didn't realize, which was really around some of the potential target acquisitions we could bolt on to our platform businesses. Specifically in our example, we have a maritime business that's a B2B service, and their customer base has been significantly impacted because of the lack of people going on cruise ships or people that are generally shipping things on container ships. So what we've noticed is as the management teams have been really challenged with how to manage the business through the downturn, we've said, okay, let's look at where opportunities might be for some of the more fragmented companies might be. It's a very fragmented market. And we saw a lot of the small mom and pops not be able to manage the downturn as well. And when we assessed our region that we were missing, we thought this would be a great time to then look and investigate whether, for example, Europe was an area we were not playing much in this global industry. So we're picking up a few opportunities now and identifying them, as well as using this time to assess whether there is a capability within those bolt-ons that we would like to acquire, right? So they might not be able to pivot as well. And then we see there is still some value in acquiring those companies. And it's allowed us to do just that. So we're finding ourselves having to do this multiple times across several portfolio companies that are challenged in the same way, but looking at those opportunistic areas while not hampering those management teams with too many questions, because they really have to manage the business day to day and get through this downturn, by the way, which in some cases can be a hockey stick return because of the pent up demand, depending on the business model.
Yeah.
So one of the greatest challenges that we're having to wrestle with is how do you kind of walk this fine line of making sure the business manages through the downturn, but has the capability to be there and service those assets and meet the customer's requirements when things do pick back up. So that's been an interesting dynamic that we've had to manage, if not week to week, day by day across our portfolio.
Yeah, I think there are definitely a lot of parts that also echo what we see in our portfolios, where you have significant shifts in customer or in the supply chain as it was before, and you're questioning whether that's eventually going to be back to normal, or is there any maybe even permanent change that you can drive out of this. And so going back maybe a little bit also to the blind spot themselves, because right now I think at least for us, it's sometimes also a question of whether there are more changes coming up that you probably don't necessarily anticipate. So the question is also a little bit for us, if you have to broaden your questioning when looking at the business, and probably also consider factors that you haven't considered before. Sean or Cynthia, what are your thoughts on that, or also on the comments that Rick made?
So I'll start with that. So the way we have thought about this crisis is really the way on a macro level we think about advising our clients to think about the future in general, which is now, next, and new. And so now has obviously been the triage component of this crisis. Next would be the restart. And then new is, as part of what comes next, are there new opportunities that you can and should be thinking about? So I think the new takes a couple of different possible routes. One is things like telemedicine, where the delivery mechanism for an existing service changes dramatically. Another would be work from home, where the provision of service exists in a different environment, which will change the nature of real estate. It will change the nature of how people work and how they team. Then think about demand. And as demand has dropped, thinking about what other ways to augment sales and to augment products and services being put out into the market. There are some companies that have done brilliantly at this. They've pivoted quickly. They've thought about what is core. They've thought about what they can do with what they have. And it's taken a couple of different forms. One is what exactly is core to what they produce? What is core to what they supply? So in other words, producing differently or supplying a different product or service, but using the same fundamental production. And then lastly, scale. right? The ability to scale, we think there are tremendous opportunities in the market right now for that, because companies that were not available historically, we think are going to become available. We think scale will help. We expect to see a fair bit of consolidation. And then from an acquisition perspective, if you talk about those things, you've got scale, you've got adjacencies, which is what can you do that's like what you do, taking advantage of your infrastructure. And then lastly, what is different that perhaps didn't exist as demand? And one example would be hand sanitizers. We have a client who imports containers from China, puts product into it, and then distributes the product out in the US. Much of their demand for many of their products has declined so precipitously that they were facing almost certain termination and death. But they figured out that their core is importing containers and filling it with product. And if you think about it, hand sanitizers have become an enormously in-demand product. And as a result, they may have the best year they've ever had, using the same supply chain and the same distribution chain that they've always used, but a different product. So we think there's a number of opportunities in the business planning phase as well as in the implementation phase for companies to use this crisis as a way to emerge stronger.
Yeah, I can just add a couple of thoughts to that. I agree with what Cynthia and Rick both said, but I think, I guess the blind spots, and we're trying to uncover and think through these real time, and so don't have a crystal ball, but you know, what shifts will become more permanent, or at least have a major difference on how we do business today than what we've done in the past. And so, you know, we talk about sectors like movie theaters, and you know, there's some studios now that are releasing movies directly, you know, through streaming channels rather than going through the theaters. And you probably read some of the articles about some of the battles that are going on there. Delivery of content could change, you know, and be affected more permanently. Healthcare, as Cynthia mentioned, certainly another way. And then I think just the overall understanding of where unemployment is going to end up 3 months from now, 6 months from now, and you know, will the government continue to distribute this helicopter money to people to keep spending up, or will there be a permanent shift in just consumer spending? You know, the vast majority of the country, I think, didn't have a ton of savings to begin with, and while there's been some help from the government in terms of with unemployment benefits and PPP funding, that can't last forever. And so the question is there going to be a full rebound in the demand or purchasing power of the broader economy, and when would that happen?
And I think probably also an interesting point is also what will be the recovery be? Will it be 70%? Will it be 80%? And so I think that, for example, we see a lot of automotive businesses, or we have seen also a lot of automotive businesses in the past. And I think, for example, in this crisis, one example that I see is, on the one side, probably the demand for automobiles in general for private people goes down, but on the other side, ride sharing becomes less attractive with the infection risk. So what does balance out? You know the two trends, but you actually don't know which one is ultimately going to be the larger one, or the defining one, and where do you end up? Because 20 or 30% up or down in revenue is a massive number. I mean, these are changes that we probably haven't seen to that extent before.
And Martin, I think that goes to the question of whether the demand disruption is temporary or permanent, and if it's permanent, at what level. I think most people expect that healthcare, while really struggling right now, is going to rebound. People need healthcare, perhaps now more than ever. And that's everything from the most urgent care to good wellness practitioners to elective surgeries that have been shut down for the last several months. Something like eating out, I think the jury's out as to whether or not that rebounds in any material way. And then there are industries that, frankly, right now have more demand as a result of this. And the question for them is, A, can they get supply? B, will they get paid for the extra demand as they ship product? And then lastly, does that rise in demand stay post-pandemic? So I think it really is sector specific as we go back to the beginning of this. But the question of demand and supply, and what is temporarily versus permanently disrupted, I think becomes a critical component in anyone's business planning for the future.
The actual other question that I thought about this morning, I read the news from some German events, and there was just this morning a report about 2 incidents. One was in a restaurant where out of one day opening of a restaurant, there resulted 18 new cases. And there was a mass in a church close to Frankfurt that resulted in 100 cases. Most of them were basically infected in the secondary, like after they had a family member who attended the mass. And I think it's also very, very uncertain how a second wave or rebound will come, because ultimately I think people tend to probably even expect that this is going to be from now on a slow recovery that is going to continue on a straight path, and that is also, let's say, questionable, right? I mean, nobody knows that yet, and that needs to be factored in as well.
Well, and not only that, but for certain industries, the demand is going to be mandated by the government. So take restaurants. What they're talking about in many states is that you can open, or in the case of New York Metro, you will open, but only at a percentage of your prior capacity. So even if the demand from the consumer is there, the ability to provide for that demand is not going to be there just by virtue of regulatory and government requirements. So I think those are important things to consider. And again, no one's got a crystal ball as to how governments are going to respond, what happens if the infection rate spikes, whether there will be a double dip in the fall, all of which make business planning and in this environment quite challenging, along with valuation as well.
Maybe following up on that, also a question to the panel. I mean, obviously, the demand can be driven by government regulations, but the support as well. So does anybody have seen where it's a make or break, depending for let's say an acquisition or for a business model, whether certain government funding is available or a certain government aid is available versus if it's not, because that obviously needs to be factored in a business plan as well, even though it's not something that I would say is like a standard factor that drives into it.
If you use the past 8 weeks, 10 weeks as an example, most of our clients would not have survived without government stimulus aid, particularly the PPP program. But in healthcare, there were other specific programs from CMS and HHS that were quite helpful. You know, each company had its own specific requirements for what they could apply for and what they were eligible for. But I will say that the majority of our clients, absent government support, would not have made it to this point.
Yeah, I would agree. And we also learned that there were similar programs even outside the US or North America for that matter, which helped some of our more globally challenged portfolio companies that agreed with Cynthia that would not have made it through without that support. And it just begs to the point that we all see how companies are adapting to these changes. And to Cynthia's point earlier, if it's going to be longer, this panel, we spoke about how the structure of our businesses will be changed probably for the long term in a more efficient manner. So that's also going to play into how we see these businesses in terms of their business plans and profit margins will be, because they probably will be operating in a different way to manage through the longer downturn. So that's another thing that I think is going to be interesting to see how companies adapt for the long term, possibly with a better cost structure in place.
And I think that goes to the question of management and what do they do during this period? What can they do? So if you go back to the now, next, new framework, now is clearly about triage. And for us, triage is about 3 C's. It's about focus. It's about making sure you're focused on a few things to allow your brain to operate as well as possible in a crisis, and to make sure it's the right few things. So it's cash, communication, and control. And, you know, again, cash, communication, control. We get our clients saying this repeatedly, and they in turn use it with their staff. They use it with their stakeholders. It winds up being a very clever technique to help what we know about how brains operate in a crisis, which is the more emotional centers of the brain take over, and people either run in circles frantically or they are paralyzed. And so this methodology, this framework that we use, winds up helping to define what managers do and what management teams do, which is important for business planning. And it's not just important for business planning, it's important to be able to, once you have a plan, to execute on that plan. And so the way I think about management teams is managers tend to fall into one of three categories. They are either strategy and growth oriented, or they are maintenance managers. They're very, very good at maintaining what is there, being on top of things, in control of things, or they are change oriented. And those folks tend to have some ADD. They're more like professionals in my field. And they tend to be very, very good in a crisis, very good on their feet, very good in the midst of chaos, very good at sorting out what is core from what is noise. But once that fire is done, they tend to move on. So obviously the current situation favors management teams that are more change oriented. But at the end of the day, every business needs to be thinking about, not from a cash perspective, right? There's only a limited number of places you can get cash. You can, the stimulus and aid component that we talked about before, lender money, so credit facilities, managing your collections to get money in the door faster, managing your disbursements to send money out the door slower, and then making your operation more efficient so that you generate more cash for less effort. And at the end of the day, the ability to, on that last one, to make your operation efficient in the midst of a crisis should stand every business, to the extent they can do it, in really good stead coming out of this, with significantly more value attached to whatever the remaining demand is for them.
Yeah, I can just follow up on that. We're working with our management teams to really take advantage of this period where activity may be a lot lower levels and we have excess capacity in the system to focus on how we can change and become more competitive. And so, a lot of times if your business is running flat out and you don't have any slack in the system, so to speak, it's hard to make structural changes without major disruptions to your customer base or customer experience. But if your new business activity is off, in some cases 30, 40, 50%, it does give you the a little bit more flexibility to make changes without having so much of a negative impact when you have missteps along the way. So we're sitting down with our senior management teams and really kind of taking a fresh look at the business model and saying, if we were to design this business model and all the processes that go into sourcing, procuring, assembling, manufacturing, shipping, delivering products or services to our customers, would we do it exactly the same way as we've done it? Or are we doing it because that's how this business has evolved over 20, 30, 40 years? In many cases, we're finding that there are inefficiencies in the system. And so we can take some more drastic changes without it being so disruptive to the customers, because we do have the capacity to absorb that change today.
Yeah, that's it. I mean, we have seen in our portfolio also quite interesting developments. I mean, for example, that's not the portfolio, but one acquisition we looked at over the change of years, and we were wondering why their sales is not dropping down. And they basically eventually came out with, well, we had about 1.5 months of orders backlog, so we're just basically fulfilling all the orders that our previously we couldn't because our logistics chain didn't work. Or another example where exactly what you're saying, Sean, basically they had like 50 locations where they would sell their products, and they only planning to restart 35 or 40 just because they probably wouldn't do it exactly the same way the second time around. So that's I think definitely an interesting opportunity for the companies to just basically sit back and have a little bit more of a strategy session now to find out what they could possibly do differently. And I think probably also expanding a little bit on Cynthia's point about the different categories of management. Would you say generally, and that goes out to everybody, that let's say when you assemble a management team in the future, and looking at the different categories or different skill sets of managers, would you probably mix them differently in anticipation of probably another one-time event, or is there any takeaway probably from management team setup as well that ultimately results in a business plan, and then probably also in the validity of such a business plan if something goes wrong?
Yeah, definitely. For us, we saw at Genex that we didn't have a kind of broad enough management team to pivot in this situation. So we brought in a CFO, to Cynthia's point, that had more of that diversity. And fortunately, she was able to help not only get the team to kind of manage the downturn, and as Sean alluded to as well, that the efficiencies that were there, she identified them and helped implement some of the changes to drive that and help the business sustain. But surprisingly came from a marketing background as well that helped the business capture some of the work that this particular business services environmental cleanups, and was able to pick up a lot of the COVID work that was out there. There's quite a lot of cleanup work going on, and they were able to get their brand and awareness out across their 17 branches, and they're seeing quite a nice pickup. So I would definitely agree, trying to identify those weaknesses ahead of time, whether it's a downturn like this or anything else, maybe it might be for growth, putting that person in place ahead certainly pays off for the long term.
I'm just looking at the Q&A section here, and going back to the business plan topic overall. We have a question where our expectations are on deal valuations, on deal sourcing, related to the crisis now, and probably also for the time frame out thereafter.
So Martin, was there a specific question, or just more generally, what are we thinking?
Yeah, just a general expectation on deal valuation and deal sourcing.
So I'll answer first because I'm the only non-deal person. I mean, we do deals and we support deals, but I'm the only non-deal person on this. So I'll go first and then let the experts weigh in. What we're seeing is, and what we're expecting is that volume will be up and value will be down, and that it has shifted from very much a seller's market with high demand, high valuations, high multiples, to a buyer's market where many more companies are stressed, distressed, looking to exit, and that will drive volume, provided that folks are willing to do deals with some hair on them. And then as a result, value comes down. So want to jump in on timing for that? How long you think that will last, and what you're seeing sector specifically?
I had a short interruption. Did you call on anybody specifically?
No, all of you.
Okay. I wasn't sure. I didn't catch the first second.
So how about you, Sean?
Yeah, I think, well, as a value investor, I've been struggling with the acquisition valuations for a long time, basically for the last 5 or 6 years. So, I think a lot of that's been fueled by low interest rates, which, given the environment we're in today, I expect that to stay low for a long time. But it is a lot of the multiples that we've seen recently were fueled by easy money lending and I guess loose covenant lending and really cheap financing. And I think that at least what we're seeing in the middle market, a lot of that's come in pretty sharply. So a lot of financial institutions say that they're still in business, but their credit terms have gotten a lot tighter. Pricing's gotten more expensive, and so I do expect that alone will have a material effect on valuations. And I think as companies look at the demand equation that we talked about earlier, and with unemployment likely to be stubbornly certainly above where it has been for the last few years, that'll have an effect on demand in many sectors. And so that muted demand will have an impact on valuations as well. So yeah, I would expect to see valuations come in and stay at certainly levels below where they have been for the last couple of years. I don't know when they creep back to where they were, but we've got a very dynamic economy with a lot of flexibility and a lot of smart people and creative forces in it. So I'm not going to bet against the U.S. ingenuity or U.S. economy, but I do think it'll be more muted for some period of time over the next year or so.
Yeah, I would agree. We've seen valuations decline as well. But as far as the sourcing side goes, we've picked up a little bit more on the proprietary side and seen more activity. I think, Cynthia, you mentioned that as well. So we're kind of busier looking at it, but it's harder, right? Because we're trying to figure out what the real value will be for these new opportunities we're coming across. So not just business planning as you might normally think from a financial point of view, but then looking broader at the real value that these assets can bring. It might be in a way we haven't looked at before, whether it's diversifying our portfolio or maybe there's a longer term view on a specific capability or technology. So we've had a harder look, definitely spent more time looking into deals through our proprietary sources and trying to identify where there's some real gold nuggets out there, but it's certainly picking up, and managing that balance of making sure you got the valuation correct as well as where it could add value is the real trick, but nothing much more to add there.
I'll throw something out there to the panelists, just to my colleagues here, and see if you guys think differently. But you know, we've had a growing problem with we read a lot about the wealth divide and the growing wealth divide in the U.S. And so one of the things that we've talked about a lot is whether we thought about how do we address that within our portfolio companies? How do we provide better wages across the portfolio companies that we're invested in? And I wonder if the pandemic right now has really highlighted the magnitude of that wealth divide in many cases. And so I wonder if there will be a rebound effort or a concerted effort to sort of bridge some of that gap in the form of higher wages across portfolio companies, which obviously reduce profits, but may be better off for the overall economy. And so we're talking about that internally. I know friends at other firms are also discussing that. So I'd just be curious to hear if you guys see that or think that that could be maybe a positive outcome from the pandemic environment we're in.
Yeah, we've certainly chatted about that as well. It's funny you bring that up because clearly, as far as company performance goes, if you're not going through a triage and you can see yourself getting through the downturn, we've spoken about, okay, really resetting the motivational targets for these teams to still perform well, particularly in service-related businesses where we have several technicians going out there performing jobs, and they are not only outperforming jobs in environments that may be at risk from the natural nature of the work, but when you add this COVID impact on top of that, now they're thinking, okay, I don't want to be in a vehicle with somebody else that may have an infection or something to that effect. So resetting, whether it's a bonus plan or any kind of other financial incentives for the teams that are doing the work, is something we've considered once we get through the downturn. And actually that's been discussed already in some cases where some of our portfolio companies are seeing already a slight pickup just because they're in the right kind of spaces and markets. But that's just one way to do it. The other way we've also looked at is simple, small rewards and motivations that will help them find a new customer, find a way to grow the business. It might be a new capability, and some of the best salespeople are those field employees that are doing the work. Or they might be in a shop. You know, they might design a better way, a better widget to perform in the factory. And those things are now paying more dividends for us, particularly when they expand the ability to grow revenue, or we're also looking at ways to develop new services and products. So it's actually funny you mentioned it, Sean, but we've been talking about it more and more.
Martin, what about you? Are you seeing things along the lines of wages increasing and talking about the more philosophical components of this crisis and what it means for the go forward?
We don't see direct impact, but I think my general view on that is typically when a new business model comes into play, may it just be a company selling PPE equipment that hasn't done that before. Typically businesses and established business models tend to get more and more efficient over time. So the focus on cost cutting and with that also on wage cutting becomes more and more the pressure. So I think just by the pure nature that of some companies having to review their business models now will provide opportunity for higher profit margins, and then hopefully also for higher wages, and also basically being able to probably provide a little bit more creativity to some of the management or even just smaller leadership teams to come up with new ideas that ultimately can be financially rewarding for everybody in the company. I think that's something that we would see. I mean, just a simple example is probably like a preschool that had done in-person education before, and now all of a sudden they can do that remotely without necessarily having to adjust the prices in a very short term. So I think there's opportunities for businesses that are really quick in incorporating these new ways of teaching, and in that particular example, or also being able to provide better service just by the mere fact that they're quicker and can establish a niche for themselves that honestly hasn't been there before. So I think there's a lot of opportunities for companies that have a creative workforce, and that will ultimately be able to pay back financially also.
Yeah, and I have to say, to Sean's point, we are not seeing things like what to do about the great big problems like the wealth divide. Where we saw it and those conversations took place were in the decisions about what to do with staff at the beginning of the crisis. So do you lay off more people and keep salaries for those you retain higher, or do you cut across the board, keeping more people employed but at a lower level? Each of our clients took a very different approach depending on their business, depending on who they had working for them. What we are hearing a lot of in the go forward, as far as the bigger questions on business models and business relationships and the global supply chain, is do you bring, particularly for manufacturing, do you bring your manufacturing capabilities, or at least some of them, onshore, which will have, not unlike wage growth, significant impact on cost, with the hoped for stability and reliability that you don't necessarily see when your supply chain is all beginning overseas, particularly in countries that may or may not be friendly to us as the geopolitical landscape shifts. So that's where we've been, the bigger discussions that we've heard at our client sites.
I'm just going through the Q&A here, and I have a question that I think fits right into that part, which is, when do you think the buyer's market will be in full swing? For instance, when do you think the rise of the buyer's market will be at its peak?
Well, since I was the one that said it, I will jump in. I think it's already starting. I don't know, it's certainly not in full swing, but Cohn-Resnick has a transactions advisory group that historically has been quite busy. And there was a big lull right after the crisis started. And as the shutdown happened, they have seen an enormous pickup in the last couple of weeks. In the last week and a half, our restructuring practice has seen a massive inflow of requests for support on transactions, both in and out of court. So I think it's already started. I don't think we're seeing the outward effects of all of it yet. But I would say, if you think about restart as taking place starting 2 weeks ago, ramping up through the fall, assuming there's not a second dip, and companies and their stakeholders having to grapple with, what does this mean? What can I become? What have I become? What are my options and potential for the future? I think that's when you're going to start to see a ton of activity. So I would say late Q3, early Q4 for what would be the outward manifestation of all of that activity, probably hitting its peak sometime in mid 2021 would be my crystal ball guess.
Yeah, I think I would echo that. I think it's definitely starting, in that we're seeing opportunities now that we wouldn't have seen 3 months ago. But I think both our firm and talking to a lot of friends in the industry, it's tough to know. I think a lot of people are just sort of in a wait and see mode right now, because as you start to see parts of the economy and the country open up, and it is state by state and it's regional, and in other countries as well, I think people are nervous about a second wave of infections and what that might mean in terms of a lockdown. You heard some of the examples earlier of churches or businesses where you're seeing cases rise. I think North Carolina just reported their highest one-day case total in months over the weekend. And so a lot of my friends who are in the distress business are still sitting on the sidelines saying, I'm not sure now's the right time to plow in, because I think we'll see another leg down coming this fall. So I don't know when that buyer's market peaks, but it's probably going to come in waves over the next 6 months, and then probably, I would assume hits a peak more into 2021 sometime.
Yeah, I would say next year for sure as well. Nothing, no crystal ball that would say whether it's going to be early, mid, or late, but certainly it started, and that we would definitely see a lot more activity at the beginning of next year and into the mid. But whether it sustains, I think it'll be a matter of how much there's a revamp or a recurse of cases coming up again.
I think to the extent it will be a complete buyer's market also depends a little bit on the processing of those transactions until they become visible for a potential buyer. Because I think there are a lot of companies that don't know yet they're going to be sold, or they're going to be in a position to be the seller in the next weeks or month. And also talking to a few people from the M&A community, there are some very proactive investment banking and M&A firms that really change their business model in the sense that they are trying to provide a very, very quick and efficient process, probably not the perfectly populated data room, but really going into situations where it is really necessary to find a buyer very quickly. And I think the more that is the case, the less of a buyer's market it will be. Because ultimately, if the process takes a typical 3 to 6 months until the first round of buyers or potential buyers is identified, that may be a little bit too long for the company. So I think the further down the rabbit hole you go, the less of a buyer's market, the less of a seller's market you will have. So I think it also depends a little bit on do you get your investment or value proposition out to the market quick enough. Or is basically reality catching up with you quicker than you can sell.
And Martin, to piggyback on that, I think it's really important for folks to understand that a distressed transaction is a different animal from a healthy transaction. The time frame is different, vastly accelerated. The access to information is different. The starting point for what constitutes a historical base or opportunity is different. The valuation very often is pegged at 0, and you work your way up as you find good things, as opposed to pegged at a multiple of prior EBITDA, and then you work your way down as you find bad things. But I think that they are different animals. They require support from good advisors, from counsel who are familiar with how to do this. And cash runway is oftentimes very, very short, which really just adds to the hell of how do you get from here to a closed transaction in time for the company not to run out of money. And I think that is going to be your point about buyers and sellers markets. Much of what we see coming down the pike for volume are deals that have either some or an awful lot of hair on them. And so they're not going to be the typical 6 to 9 month processes. It'll be more like 2, 3, 4 months at most.
What's also going to be different too is for those acquisitions that are in markets that we're already familiar with. So maybe doing bolt-ons will have a much different approach because you have that inside intel already through the portfolio company you're working with. And that's where it's important to use the management team's relationships and maybe the local management teams, if it's a global business, to really suss out where those opportunities might be versus going into a completely new market. If you're trying to diversify your portfolio or get into something that you haven't done before, that'll be like Cynthia said, a very different marketplace and a very different process to go through.
I'm looking to Lena. Do we have time for another question, or are we out of time already?
If you want to get to one more question, I think we can, and then we'll try to wrap it up. Okay.
Then we'll take a quick one. Well, quick one. I don't know. At least a short question. And that goes back to the buyers and sellers market that is coming to a change now, coming from a typical sellers market. What do you guys think would be an incentive for company owners to sell now if they don't have to? So basically, who would possibly voluntarily sell in this market? Is there any reason you could come up with for that? Or do you see anything?
Well, if there's a unique upside because they happen to be cleaning up COVID cases, that might be one very unique situation. But other than that, I can't think of anything else right now.
So I'll offer a couple. One is the company is not doing well, and a transaction is their only way out, as opposed to a simple liquidation or wind down. That would be the most obvious, and we are actually seeing a lot of that already. The second is fatigue and lowered appetite for risk, right? Folks who are of a certain generation, of a certain age, they were looking to coast through their retirement. This was their retirement. And now, given what's transpired and no certainty that there won't be a second dip, I think for many people, the first loss or the first offer is the best one. And so I think folks are looking to simply stem the possibility of additional loss or mitigate additional risk. And then I think for other businesses, even though the value might not be as high, the benefit of scale, which I think everybody has seen in this crisis, offers tremendous benefits. So as a standalone, you might not have nearly as many opportunities as if you were to be acquired and be able to combine with a larger or similar size or larger entity to create scale in the marketplace. It creates defensiveness against further crises and further challenges. So those are a few of the reasons that we are seeing people look for transactions presently, sellers particularly.
Yeah, I'll just add, we're working on a couple of transactions right now where the sellers don't necessarily have to sell, but for the reasons Cynthia outlined, in one case, it's more of the age of the sellers and the owners, and they're looking at their stamina for the next 5 years versus bringing in a partner to help them. In another case, I think the pandemic's just exposed some serious weaknesses in the business, and they're looking for some outside help and governance and supervision to help bolster or stabilize some functional areas of the companies. But I will say what we're seeing in those situations is instead of selling 100%, sellers may be selling 55 or 51 or 60% and keeping a big piece of it. And we're encouraging that, obviously. So a lot of our cash is going in to fund liquidity needs and working capitals as the business ramps back up, or hopefully ramps back up, not necessarily putting a lot of cash into the owner's pockets, but because of where those businesses are. But the hope is that there will be another exit at some point down the road for those owners to cash out and hopefully in a much bigger way.
Yeah, I think we probably see some of those considerations as well, where especially when you have a significant size difference between the customer, who's most likely very much bigger than the supplier needs to think about whether I am the most strategic supplier for that particular customer, or am I gonna probably be the one that is left on the roadside when the customer needs to basically look at who they're gonna like bail out or support going forward. And people that have a little bit of a strategic planning will realize that, and that they also come to the conclusion that they are better off being consolidated or like working in conjunction with other people as well. Good. I think that marks our end spot here.
Yes.
It does. Okay. Well, first of all, thanks to everybody again for attending this panel. I think it was a very interesting conversation. I definitely learned a little bit. And thanks for the audience. Unfortunately, we didn't have time for more questions, but maybe we can I don't know if you can answer some of those in writing afterwards, or if there's any means that we can provide more insight, but Lena can probably let me know afterwards, and we can see if we can do that.
Yes, absolutely. And thank you, Martin. And of course, to our panelists, we appreciate your contribution. I think that was a very insightful discussion. Thank you to our audience, to our sponsors, of course. We are doing webinars weekly. We will have some more information on next week's webinar on the 4th shortly, so look out for that information. Today's webinar will be posted on our YouTube channel, so look out for that as well. And we look forward to seeing you all soon. Stay safe, and we'll see you soon.
Thank you
Thanks,
so much.
everyone.
Thanks, everyone.
Thank you, everybody.
Thanks.